So I had been listening to podcasts. I knew I needed to get into real estate investing. I knew that I wanted to do it. So I didn't have a lot of money. I was just starting out in real estate. COVID had just happened. But basically, on the day of closing, the amount of money I put out for the property, 3.5% versus the amount of credits that I got plus rental income, I was into the property for less than zero.
Hey guys, what's up? It's Monte Reyment here on the Why Do I Suck as a Real Estate Agent podcast, where in reality, we're trying to help people not suck. Today, my guest is a really good one. I'm excited about this one because I have Michael Scanlon here from the Chicago area. He's a team leader of the Axon Group at EXP. He's a 5-time Icon agent. He's pretty much won the award every year since entering real estate, which is pretty cool. He's been in 6 years and he's won it 5 times. So that's pretty impressive. He's projected, or his team is projected to do over 400 transactions in 2025. And he's a real estate investor too, which is really how I got my start. Got a pretty nice portfolio going for himself. So Michael, welcome to the show, man.
No, thank you for having me. I really appreciate it. Really looking forward to this and really glad that we can hopefully shed some light on how to work with investors. It's a little bit of a niche area, but it's my favorite. Sounds like it's one of your favorites. I'm really happy to talk about it.
For sure, especially this time of year where tax returns are, guys need to dump and buy some properties for tax purposes. This is my favorite time of year.
Yeah, I may or may not be closing on a property today after we get off this podcast.
I love it, man. I love it. So tell me a little bit, how'd you get involved in real estate? It's always I'm always interested in the backstory a little bit just because of the fact that, like, my background is sports. Where did you come from?
So I've got a very random background. So my undergrad degrees are in psychology and I have a random criminology degree that really didn't mean anything. And so I worked with kids with autism for 6 years.
Okay.
And I lived overseas when I was doing it. I was playing rugby and living in Australia while I worked at an autism center. And then
Awesome.
Came back and realized that doing that for the rest of my life was very fulfilling, but not financially fulfilling. And decided I was going to get my MBA and went down that path. And I was working the most random jobs while I was getting my MBA, like catering events and things like that. And I remember being at one of the events and one of the caterers, just this random caterer who's working a nighttime catering job as well, is, yeah, I'm flipping houses. I'm like, you're what? And they said, yeah, have you ever heard of Bigger Pockets? And I'm like, no, what is that? And so I started listening to the Bigger Pockets podcast and ended up listening to that constantly throughout the course of getting my MBA and afterwards, and kind of realized as a numbers guy, my MBA is a finance track, that the numbers in real estate are so much better than any other investing avenue. So I said, I'm going to go that route. Of all the finance routes that I could go, that's the route that I'm going to go. And eventually decided in 2019 that I was going to get my license just so that I could be my own agent. And then 2020 happened, and we all know what happened in 2020, and did not really have a lot coming in financially because the work that I was doing at the time, I was working in business development. They shut down their progression with the way things were going with COVID. And so I needed to find some other ways of making money. And so I started to utilize my license working with other people. And now I'm here.
Love it, man. I love it. That was similar to me too. As I mentioned off air, my brother got me started in real estate as an investor as well. I was down in Chicago working for a company that was helping, like, I was a middleman for high school student athletes and college coaches. Burned out on that and found real estate similar to you, and just being creative. I don't have an MBA. I don't have the brain like to get me through school that would get me through an MBA, but just seeing a different way and seeing just your regular guys like out there just making a good income. And that intrigued me. But what I really started liking, why I switched to being an agent, was I liked helping people build their businesses too. And essentially that's what I'm doing here as a broker too. So that's awesome, man. I guess one of the questions I have, and we talk about working with investors or being investors ourselves, but also working with an agent that's investor friendly. Why should somebody choose, and other than the obvious because you know it, but why should somebody choose you? I get the question a lot of times, oh, you're an investor, so you're going to just steal deals. But what is it about an investor-friendly agent that helps investors grow their business?
The first thing is regarding hey, you're going to steal all the deals. If I had enough money to steal all the deals, I wouldn't be doing this. I don't have I don't have the money to be buying all the
Right.
deals, and 99.9% of everything goes through to clients. Yeah, I've bought deals, of course I have, but the majority of things that I've bought have been off of the MLS, things that were available to anybody else. And I just saw a different way that it worked for me. And I've always taken the approach of I don't need home runs. I can just hit a bunch of doubles
Yep.
and still come out ahead. With that regard, yeah, not a massive concern. Yeah, occasionally there might be deals that an investor friendly agent would want for themselves, but it's not a huge thing. But why you should work with an investor agent, the way that I've built my team here in Chicago has been pretty simple. We learned a lot of things early on. And the things that we learned early on were it is very difficult to take an agent who doesn't invest and teach them to work with investors, even if they've been doing it for 20 years. Yep. Whereas you can take somebody who's never been an agent that does invest and just teach them, hey, here's how you write a contract. Here's how you fill out disclosures. Here's how you request showings. Here's how you do all the procedural stuff and protect yourself. But you already know how to run numbers. You already know what a good deal looks like because you've been doing it day in, day out for X amount of years. And so that comes across in terms of the real world experience. That's what we look for. That's what I have, that's what you have, that a lot of agents may not be able to provide. And there may be agents that are really good, that have read books, that know how to run numbers for investors. There's a different level of understanding of how these numbers play out in real life when you've done it, when you've seen it, when you can take a look at a deal and you can say, this is why your costs are going to be this. Or when I can go to a property and I can say, oh, this is a new construction 3-unit here in Chicago, your water bill is going to be about $150 a month. How do I know that? Because I have a 3-unit new construction in Chicago, and that's what my water bill is. And it's the same amount of beds and baths. Like, I can pull these numbers really quickly. I've analyzed so many deals for myself and for clients that I know what a good deal looks like without honestly even really having to analyze it. If it's close enough to a good deal, I will then analyze it. Of course, I always do. I have big spreadsheets that I love to use, but just that first world experience of how things work, knowing exactly what rent should be in certain areas, there's just this little ingrained knowledge that you don't have to look up.
Let's talk about breaking down and analyzing deals. Like, for somebody that's out there who maybe is on the verge of, because this podcast is really geared towards real estate agents, but for somebody who's like potentially an investor friendly agent, where do they start as far as analyzing deals? I have a pretty good idea, but you're on the show, you're the expert, so let's roll.
Where to start? Just start simple. You want to start just analyzing basic cash on cash return. That's the metric that everybody talks about. That's the easy one to compute. That's not the end all be all, but for anybody that's never analyzed any of it before, you basically take your gross income minus what everybody listening should know is PITI. So principal, interest, taxes, and insurance. And then you have to take out certain factors. So when we do commercial, I do commercial as well. Lenders will force certain minimums, 5% vacancy, 5% management. Doesn't mean that you're not going to self-manage. It doesn't mean that you're going to have 5% vacancy, but those are your safe numbers. And then you want to run safe numbers for expenses, repairs and maintenance. In commercial, you don't remove CapEx, but you can take out CapEx. That's capital expenditures. If you need a new roof, if you extrapolate that over time. But basically, your water bill, any common utilities that you would pay, you have to take all of that out. It's not just as simple as, hey, this property makes $5,000 a month. The mortgage is $4,500. You're making $500 a month. No, you're losing money at that. Yep. And so that's important because I have actually come across agents who have told me, oh yeah, this is a great deal because it makes $500 a month. And they're on the listing side and they're trying to push their own listing, of course, but they don't realize all of the things that need to be taken out to make sure that this is a good investment. And then at the end of it all, let's say you invested $100,000 and you're going to make $7,000 of pure profit after the end of everything. That's a 7% cash on cash return. So you want to start there and then you build from there. You want to make sure that your clients are understanding other things, like what is the average appreciation in your market, because that is a very important metric on how you can sell investors versus something like the stock market. Somebody can come to you and say, oh, this property only makes a 6% return. I can make 7% historically in the stock market. Why would I buy this property? Well, if you're a pure investor buying a 4-unit building and putting 25% down, that's the Fannie Freddie standard, then guess what? 3% appreciation is 12% return on your money. Why? Why? Let me just explain it with the numbers. So you buy in $1 million building, you put down 250,000 in $1 million building, goes up by 3%. That's 30,000. 30,000 over 250,000 is a 12% return on your money. And then not only that, but at current interest rates, you're going to pay down about 4% ish of principal per year on your loan. So that 6% cash on cash plus 4% principal pay down plus 12% return on appreciation, levered return on appreciation, means you're coming away with about a 22% return. Now, only 6% of that's in your pocket, but 22% of that is a real spread between what it costs you and what you're ending up with at the end of X amount of years when you decide to part with that property or refinance that property or whatever.
Yep, exactly. That's outstanding. And also, too, I work in the flip world a lot, too. I got a lot of people that flip houses. So then you same principle, but you use the ARV, right, which is the after repair value, subtract the rehab costs and the holding costs, taxes, all those things are combined into that. And then your profit on what you want to make, and that's your maximum allowable offer in a nutshell. So yeah, those are certainly ways. I get a lot of that. A lot of up here. We don't have as many, certainly we don't have nearly the market you guys have in Chicago, where it's a lot more rental opportunities there than there is here, but still same principles, right?
Yeah. And we also have quite a bit of flipping. Didn't mean to glance over flipping.
Oh, that's cool.
But we have, the last time I checked, and it's been a little while, but we had something like 2,400 active multifamily listings. And so we have a lot of multifamily here. Chicago's a big multifamily market. And so it's a lot of buy and hold investors that we come across. And that's more of the long-term wealth growth versus quick. I've got flippers who are doing very well for themselves. I've got flippers that I don't personally work with that have lost plenty of money. And I've heard the stories. I like to think that my flippers always make money, but that's the slightly higher risk, higher reward venture. But yeah, there's different ways to look at it no matter what. But when it comes to flippers, I would also say, make sure that they get an evaluation from a contractor too, because hold me to my estimate. There are simple metrics that we use, and I don't know what it's like up there in Green Bay, and every market is different. But on a cosmetic rehab, depending on finishes here, we're about $65 to $85 a square foot. And then on a full gut rehab, it depends on the level of finishes you go, but we're usually 100 to 125 a square foot. And then we've got areas where you go as much as 180 to 200 a square foot if you're really going luxury.
For sure. Yep. Good. Now, you had mentioned early on, and I thought this was interesting, is you identified that there's not a better investment than real estate versus stocks in other ways. One of the questions I have for you, and I get this all the time because I mimic the same thing. Why is that? First of all, why do you believe that? And two, and again, I already know the answers to this, and then two, how do you combat that with somebody who comes to you and go, no, my buddy's a financial planner or whatever in real estate, whatever. Is it something more that you feel like you're just comfortable with because you know it more, or because you actually have run the numbers?
So I've run the numbers, and it's funny. I love listening to both real estate podcast and financial podcast, and then financial YouTube videos. New Money is a really good one if anybody just wants to watch YouTube videos. There are lots of different ways to look at real estate, look at investing in the stock market, and ultimately it's up to what you're comfortable with. But when I analyze the numbers, I've mentioned this before, that you've got all of your hidden returns. So you've got your cash on cash in real estate. You've got your levered return on basically inflation. And then you've got your principal pay down. So those are hidden returns. There's also other returns. If you're an agent out there, this may be a completely different topic because it's in depth, but look at doing cost segregation studies on your properties and how that can provide you tremendous returns. I've done 6 or 7 cost segregation studies on my properties. You can only do one per property, but basically what that allows you to do is accelerate depreciation and offset that against your income, because all of our income as real estate professionals is considered in the same pool. So losses on a property offset losses on our real estate commission income. It's not illegal. It's a completely legal loophole that the IRS has in the tax code. So that's another way that it can be super beneficial for people like us. But then you look at the stock market, and it is very rare historically that anybody has ever sustainably beat the average S&P. Things average out over time. There have been 2-3 year stints where certain funds have outperformed the market, and there have been bull runs in the history of the stock market where the market itself has outperformed a lot of other things. But for the most part, it eventually comes back to a level. So from a long-term perspective, you're eventually going to settle into the average historical return of the stock market. And that's just, it is what it is. It can't stay high forever. We have average GDP growth, and the stock market is essentially going to mirror the average GDP growth. So there's people that think that they can beat the market. It's very hard to do. Real estate, realistically, is the way that you can lever your money. And I think that's the most important takeaway, is that unless you're buying options, which can be inherently risky, there's not another way to really safely lever yourself in the stock market. If you're buying $1 million of stock, you need $1 million. If you're buying $1 million of real estate, you could be putting 5% down if you're going to live in it. If it's a multifamily, 3% for a single family. So you can be extremely levered and experience the returns of real estate on a much smaller amount of money because of the American mortgage system.
Yeah, for sure. So let's talk about your first deal. I know this was one of the interesting things I got in the notes was you were down to about $2,000 left, and you got your first deal with only about $2,000. How did that go down?
So I had been listening to podcasts. I knew I needed to get into real estate investing. I knew that I wanted to do it. So I didn't have a lot of money. I was just starting out in real estate. COVID had just happened. And so I decided this is the route that I'm going to go. 3.5% down FHA. And I'm going to ask for a full commission on this deal. And so I was able to purchase it 3.5% down. It was a condo, 3-bed, 2-bath. I went on Facebook Marketplace, which I had been studying for a year and just watching posts on Facebook Marketplace, which is where a lot of the rent by the room stuff happens in Chicago. I don't necessarily recommend renting by the room unless you're going to live there. But if you need roommates and you're younger and you can tolerate roommates, that's where you would typically find them here. So I put this deal under contract. I had a 3% commission on it. I had it fully rented from the day of closing. The other 2 bedrooms were rented to other guys for $1,200 a piece. My mortgage was $1,900, and then I had a $200 HOA. So I was paying $2,100 plus utilities, which I split with the other guys. And then the other guys were paying me a total of $2,400. And so I was living for free. But when it came to the breakdown of the deal, I was able to get myself a full credit on the deal. So I bought it for $310,000, but I got a $10,000 closing credit. And then at the time, I took a slightly higher rate to get a slight lender credit. And then I eventually refinanced. And so that property is now at a 3%. But then at the end of it all, when you are receiving rent on the day of closing from your tenants who are moving in that day, on a normal multifamily deal, the rent credits would be given on the settlement statement. This, I was renting to people who weren't already living there. So it was a little bit different than a normal deal would be. But basically, on the day of closing, the amount of money I put out for the property, 3.5%, versus the amount of credits that I got plus rental income, I was into the property for less than zero. I had less money into it because I also got a 3% commission on my own deal. That's one of the things that you can do that's pretty powerful as an agent. You can put 3.5% down FHA on realistically a 2-unit. Right now, with where rates are at, 3 and 4 units won't pass what we call self-sufficiency. That's a topic for a different podcast. Yeah. And then you can put 5% down conventional on a multifamily. That is very doable. That's a product that they came out with in 2023 when the rates started to go up and FHA self-sufficiency wasn't being satisfied on any of these deals, so that it could open up the 3 and 4 unit market. Get yourself a credit to cover your closing costs. Ask for a commission between the tax proration, the rent prorations, the credit that you're getting, the commission that you're getting, and then the fact that, let's say I'm closing a property today. It is, what are we at? The 9th of December. I'm getting rent credit for the rest of December, and then I'm not paying a mortgage until February 1st. So you don't pay until the month after the month that you close. So now I'm going to also get the entire month of January of rental income without paying a mortgage. So that was something that happened on my first deal. Was then I also got another 2,400 the next month and started on the road to recovery financially. I definitely took some gambles with that first deal, had very low liquidity when I came out the other side of it, but then I was living for free for the next 2 years while working in real estate, building up some income. And it's very doable for a lot of agents out there in a lot of markets.
I love it too. And using the commission towards the down payment, that's something that people can do now as well, which is awesome. And man, that's the BRRRR strategy, right? But a very creative way to go about doing the BRRRR. There's a lot that went into it.
Yeah. Yeah. You got to be creative. There are deals that I've bought other than that have been extremely creative. And this is probably my favorite one. And I'm going to just transition as myself. I bought 2 properties once for $1, and that was my favorite deal ever. And I remember talking to an institutional investor who was interested in some properties that we had. And I told him about this deal, and he's like, man, I've been doing this for 25 years and I've never heard of that before. This was shortly after I bought that condo, and I did not have basically any money. And I knew that these properties needed full gut rehabs, and I knew that I couldn't afford to buy them, but I wanted them. And so this guy was trying to sell them on Facebook Marketplace. I used to use Facebook Marketplace all the time. And so after 4 months of going back and forth with him, I got him to agree to quit claim me the properties for $1, 2 different properties. And he was then going to be a member of the LLC and receive a payout when we finished the rehab. And so I got the properties for $0, was able to then get my construction costs covered from there and then refinance out when we were done. One of them, I should say. The other one we did sell just because over the course of COVID, it was in a townhome complex that changed the rules on rentals while we were doing the rehab. So we did sell that one.
Sure.
But yeah, I was able to pay him out at the end rather than pay him up front. And now I solely own one of the properties. He wanted to get bought out of it after we finished it. And I basically have none of my own money into it. So there's a lot of different things that can be done in real estate that are legal if you get really creative. I've signed on a deal with a client, a commercial deal, where we found out pretty close to closing that she had an undisclosed bankruptcy from 5 years prior, just short of 5 years prior. If it had been, I think, more than 5 years, she would have been good. But she had co-signed on a loan with her son, and she did not remember that she was still liable for that. And so she was going to get denied for the loan on a $1.127 million commercial property. I have, at this point in my career, several properties under my belt. I'm going to make the deal look better. Our interest rate actually went down on it because I was a less risky borrower. And so I applied my commission toward the deal and was able to then sign the loan. And yes, I'm signing a promissory note. I know that there's risk inherent to that, but the value of my commission on that deal was something like 5.5% of the total down payment. And I got 15% equity because of the risk that I was taking. So now I own 15% of a property that at this stage is probably worth 1.45 because we did quite a bit of rent raising in that property. And all I had to do was give up my commission, which I was going to lose because that deal was going to fall apart anyway. So I basically gave up nothing and just signed a promissory note. And now that equity in that deal is probably worth $90,000.
Yeah. That's awesome.
So you have to be creative in real estate, whether you're working with a client, whether you're doing it for yourself, and there's a lot of different ways. So just look at it as not, can I do this deal? Like, how can I do this deal?
Yeah. And I think one of the, maybe that's the behavior we focus on today is the problem solving, right? Like you have to be a problem solver as a real estate agent to not suck. Right? If you're just going in there and doing paperwork and you're not really providing solutions, every single person has a problem when there's real estate. Whether it's perceived as a problem is one thing or another, but like somebody who's going from a $3 million house to a $500,000 house because they want to downsize, that's a problem for that person. It's not a problem for us or anybody else, but that's the reality, right? Like in your case with investors, the problem is I want to buy more properties. It's how do we solve that problem for our buyers and for our investors to do that? Or, hey, I have a whole bunch of equity. I don't want to get hit with the tax ramifications. So do we work through a 1031 and then we build our team through title companies and lawyers and 1031 agents and things like that? So that's a really, I think, problem solving is probably the behavior we should focus on here.
Yeah. Yeah. And you have to do it every day. I've got a client in particular that we've already closed one deal in the last month and we're under contract on another one. She had a 1031 exchange. There wasn't a lot of good stuff on the market, to be honest, in terms of 2 to 4 unit in commercial property. And I found, and this is, I hate to put this out there because it's not as common as books or podcasts will make it seem, but I found a deal on the market, a 12 unit that wasn't selling. We went and saw it. It was actually really clean. It was just overpriced. The sellers weren't willing to come down on price at all. And so I ended up doing a little bit of research and going back to the agent saying, it doesn't look like they have a mortgage on this. Is that right? They didn't. And they were surprisingly open to seller financing. And so on a deal where they would have gotten a 25-year amortization, which is common in commercial, at about a 6.25% rate with a 5-year balloon, we were able to negotiate a 7-year balloon, 30-year amortization at a 4.65% down payment or 4.65% interest rate.
Yeah.
And we put 20% down instead of 25. And so that deal is going to work out really well for them. And then they ended up having some additional funds left over because they were thinking of committing whatever it would have worked out to 32% from their 1031 because they need to use those funds. So they had about 12% of that left over. And they're a couple where they are able to use real estate professional status. One of them works full time as a doctor and the other one works full time basically managing their real estate and real estate investing. And so they're able to offset the doctor income. So that is something that is possible within the tax code as well from the real estate professional status. They had a smaller amount left, but they needed to leverage it as much as possible. So how do we leverage it? I started searching for people on the market that had VA loans, and VA loans can be assumed by non-occupants if the seller is willing. And you need to make sure. My 2 best friends growing up are both military. One of them is a retired Army captain and the other one is still active duty captain in the Marines. And so if they don't understand what it means to have their VA assumed, don't do it. But if they fully understand, and let me tell you, the seller on this deal fully understands. He is, a 46-year-old attorney. So he knows what the ramifications are of having his VA loan assumed. And he also knows that he's making a whole lot more money. So I approached them about assuming the VA loan. It's much less, it works out to something like a 16% down payment instead of 25% on a 3-unit property. And not only that, the interest rate is 2.75% and still has 25 years left on it. So we're already 5 years into the amortization. It takes less of a down payment. They still get the cost segregation on the entire value of the property. They're 5 years into that amortization period. So they're already paying down way more principal. And now this buyer is buying, a total of $2.2 million worth of property with enough money to realistically have bought $1 million worth of property because of the way that we were able to structure the deals. And that's plenty of additional commission income for me and plenty of additional value for the client, way more to cost seg, way more net worth gains. And that's what it takes. There's not always, especially in our current market with rates being high, with sellers being tight. We're very tight inventory here in Chicago. We are still down 60% from pre-COVID inventory. You have to it's the lowest in the country. You have to get creative in order to make deals work sometimes. So that's what we've had to do.
Yeah, we're tight here too in Green Bay for sure. Now, for the agents listening in, somebody that wants to possibly get into being an investor-friendly agent, how can an agent go and identify investors where they go to find those investors?
So it depends on your submarket, but we have a lot of meetups here, and meetups are great because they can get face-to-face with you. There's a lot of Facebook groups. We have a lot of Facebook groups here in Chicago as well. I'm sure that's common in other markets as well. And there's a lot of people that are constantly asking for advice. There's people that are wanting to get into it. You don't necessarily want to go down the rabbit hole of too many people that say they want to do it but aren't serious, but you also don't want to put those people off. Right. Everybody has to buy their first deal at some point in order to have a second deal. Yep. So you want to make sure that you're looking in the places where people are looking for help, because as a real estate investor who's also an agent, the biggest value that you can bring, like we touched on earlier, is that you can be a mentor for free. A lot of these people are paying for mentors. you can essentially mentor them for free because you're going to get a commission at the end of it.
Yep.
And so you give them that value of, hey, I can tell you what I know and teach you what I know. And also I can write you the offer when we've decided on which one works best for you. But then there's also websites like Bigger Pockets. And then there's plenty of different avenues from a general real estate standpoint. We get a lot of referrals from other agents within our brokerage who say, hey, I just don't want to work with investors. I don't run numbers. I'm not a big math person. Will you take this person for a 25% referral fee? Yes, of course. We will work with anybody. And the biggest reason why is if you're working residential and you're giving up a 25-30% referral fee, that's still great. I would still do it all day. But if you're giving up a 25% referral fee on somebody's first deal and then they're your client after that, referrals can be structured however you want. Some people take it for multiple deals, but a lot of people only take it on that first deal. You buy and help a buyer invest their money in a good deal, they're going to invest again and again, and you're going to have constant deal flow. And we've hit a point now where, we're always looking for new investors. We're always prospecting because you never stop. But our deals have continued to rise because as we find new investors, our previous investors are still buying again and again. We have people that buy 1, 2, 3 deals a year, and that's from the buy and hold perspective. We have a flipper who buys 20 plus deals per year and then sells them with us. So your velocity will really grow if you're working with investors, no matter how you get them. So don't be afraid to give up a referral fee or find them through a random platform. If you're really young and getting started, try things like OpCity or Lemon Brew or whatever else is out there because there's zero upfront cost to you. If you make a mistake, I'm sorry to the platforms, but it doesn't cost you anything versus paying for leads up front. And then that person might have a cousin or a brother or a friend that's looking to buy or invest or all of these things. So every lead is a good lead because it can turn into so much more if you work it right.
Yeah, in my brokerage, I don't allow them to say lead. I call it an opportunity. So they have a different look at it versus lead is transactional, opportunity is a relationship, in my opinion. So that's how I phrase it here. This has been awesome, man. Anything else you want to add? There's a lot of nuggets here. There's probably some people that are brains frying a little bit.
I would just say don't be afraid to invest if you are an agent because it really does work. Yeah, there's going to be occasional headaches. There's going to be texts when you don't want to receive texts, but the long-term gains for you are really beneficial, both from being an investor. As an investor, have grown a ton over the last few years, but also my business has grown exponentially because the fact that I am an investor now allows me to have so much credibility. If I go to somebody and I say, hey, guess what? I own a almost eight-figure portfolio. They don't ask many other questions. You go to a listing appointment for a $400,000 condo, they're going to ask you why you're better than X brokerage and what you're going to do to market the property. It's great. Yeah. You go to a buyer and you say, this is how many units I own, and this is how long I've been doing it. They're like, all right, you're my guy because you clearly know what you're doing, especially if you don't come from money. And if you do come from money, it doesn't mean you don't understand it, but I don't come from money. I have grown this from the ground up. And so it shows that I just know how to build it. Right. And that gives you so much credibility with these investors. So yeah, just get out there, do it. The scariest one is always the first one. And then from there, it gets a lot easier because you understand that it really does, for the most part, work out in real life like it does on paper.
Yep, for sure. Hey guys, that's Michael Scanlon from the Axon Group down in Chicago. Thank you so much for coming on, man. That was some great stuff.
No, I really appreciate it. This has been awesome. I'm looking forward to chatting with you in the future. Maybe not on this podcast, but we do a lot of similar stuff. I really appreciate the podcast.
Yep. Yeah, I run a couple investor groups here in Green Bay as well. So all the stuff you were saying as far as like finding groups and being involved and just getting to know them, that's how you build your team. And I think that's something we didn't even hit on is how to build your team because that's important as well. But man, that's some good stuff you threw out there today. That's maybe we'll bring you back on and circle back at another time. But great stuff, Michael.
No, I would love that. I appreciate it.
Cool. Thanks, dude. Hey guys, that was the Why Do I Suck as a Real Estate Agent podcast. As you can see, Michael does not suck. Take his advice, go and do it, be creative, problem solve, find investors. That's the motto of the show. So again, Michael, thanks a lot. And that was that episode for today. So that's a wrap here on the Why Do I Suck as a Real Estate Agent podcast. Thank you so much for spending time with me and our guests. The people you hear on this show really aren't guessing. They've been doing the work. They've been doing it for a long time. They're sharing their behaviors, their habits, their successes, their systems that actually lead to real work, real success. So please subscribe and follow so you don't miss the next conversation. Until next time, remember, you don't suck. You're learning. It's the beginning, or maybe you're in a rut, but you don't suck. So make a few changes, stay curious, stay consistent, and please keep coming back.